Something extraordinary just happened in the silver market, and most investors have not yet grasped the significance of it. Over the span of just a few trading sessions, silver experienced one of the most violent price dislocations seen in modern commodities trading. Futures contracts briefly reflected a pricing surge equivalent to nearly $121 per ounce, only for the market to suddenly collapse toward $83, wiping out billions of dollars in leveraged positions almost overnight. At first glance, this looks like typical commodity volatility, but the deeper you look into the data, the clearer it becomes that this event was not just another price correction. What we may be witnessing is the early stage of a structural fracture inside the global silver market, specifically inside the paper futures system that dominates price discovery. Silver is one of the most strategically important metals in the modern economy, sitting at the intersection of monetary history and advanced technology. It is both a precious metal and a critical industrial input used in electronics, solar energy, semiconductors, and high-precision manufacturing. When silver moves violently, it often signals that something deeper is shifting beneath the surface of the financial system. And right now, the signals coming out of the market are unusual. Large futures positions were liquidated at record speed, volatility exploded, and yet at the same time, the physical silver market did not show the same panic. In fact, physical demand remained relatively strong in several regions. That disconnect raises an uncomfortable but important question. Are we watching a normal correction in silver prices, or are we beginning to see cracks forming inside the highly leveraged system that controls the global pricing of this metal? For many people, the silver market might seem like a niche corner of the financial world that only traders and metals investors care about. But the reality is that silver sits at the heart of the modern global economy, and disruptions in this market can ripple far beyond commodity exchanges. Silver is essential for industries ranging from consumer electronics to renewable energy infrastructure. Every smartphone, computer, and solar panel contains small but critical amounts of silver because of its unmatched electrical conductivity. When the silver market becomes unstable, it affects manufacturing costs, supply chains, and ultimately the price of goods consumers rely on every day. But silver's importance does not stop with industrial demand. For centuries, silver has also served as a monetary asset, a hedge against inflation, currency instability, and financial crises. When investors lose confidence in paper currencies or government policy, precious metals often become a refuge. That means the silver market sits at the intersection of technology, industry, and global finance. If instability emerges in the pricing system that governs silver, the consequences can spread through multiple layers of the economy. Industrial producers could face higher costs and supply shortages. Investors could experience extreme volatility in metals markets. And governments and central banks could be forced to respond if the situation begins affecting broader financial stability. In other words, what happens in the silver market does not stay in the silver market. The reason this recent collapse from the equivalent of $121 to $83 matters so much is because it may reveal growing stress inside a system that underpins both industrial supply chains and global monetary confidence. The trigger for this dramatic move began in the highly leveraged world of silver futures trading. On major exchanges like COMEX, silver prices are primarily determined not by physical buying and selling, but by futures contracts representing massive amounts of metal traded on margin. Traders can control large quantities of silver with relatively small amounts of capital, which creates enormous leverage inside the system. In the days leading up to the price spike, momentum began building in the futures market as large speculative positions accumulated. Hedge funds and algorithmic trading systems pushed silver higher as key technical resistance levels were broken. Once the price began accelerating upward, additional automated trading strategies entered the market, amplifying the move. This surge created the appearance of a rapid price explosion, briefly implying valuations equivalent to more than $120 per ounce when adjusting for contract leverage and positioning. But this is where the structure of the market became dangerous. Because the rally was heavily driven by leveraged futures contracts rather than underlying physical demand, the price structure became fragile. As soon as momentum began to slow, traders started closing positions. The first wave of selling triggered margin calls for other leveraged participants. Those forced liquidations accelerated the decline. Within hours, A cascading sequence of sell orders pushed prices rapidly downward, erasing much of the previous gains. By the time the dust settled, silver had plunged toward $83, leaving traders scrambling to assess what had just happened. But while futures markets were experiencing chaos, physical markets were showing a very different pattern, one that may reveal the deeper forces at work. To understand the deeper cause of this dramatic move, it's essential to examine the structure of the silver market itself. Unlike many commodities, the majority of silver trading occurs in derivative markets, rather than through the direct exchange of physical metal. Futures contracts, options, and exchange-traded funds represent enormous quantities of silver that may never actually be delivered. At times, the amount of silver represented by paper contracts can exceed the available physical supply by hundreds of times. This system works smoothly most of the time, because only a small percentage of futures contracts ever require physical settlement. But that same structure also creates vulnerability. When large numbers of traders attempt to adjust their positions simultaneously, the leverage embedded in the system can produce extreme volatility. In the recent silver move, that leverage appears to have reached a tipping point. Institutional traders had built large speculative positions, betting on rising silver prices, driven partly by expectations of inflation and industrial demand growth. But once momentum began to reverse, the leverage that fueled the rally also accelerated the collapse. Margin requirements forced traders to liquidate positions rapidly, pushing prices downward in a feedback loop. The key issue here is that this mechanism operates largely within the paper market, which means price movements may not always reflect changes in the physical supply of silver. When that divergence grows too large, the market can become unstable. What we may have witnessed in this event is not just a correction, but a demonstration of how fragile a heavily leveraged commodity market can become when speculative positioning reaches extreme levels. Behind the charts and price movements, the consequences of these sudden market swings are very real for businesses and investors who depend on stable metals markets. Mining companies, refiners, manufacturers, and industrial buyers all operate based on expectations of relatively predictable commodity prices. When silver prices swing violently within short time frames, those businesses face enormous uncertainty. Manufacturers that rely on silver for electronics or solar technology may suddenly see input costs change dramatically, forcing them to renegotiate contracts or absorb losses. Mining companies that hedge their production using futures markets can find themselves caught in volatile margin requirements when prices move rapidly in either direction. Even individual investors are affected by these sudden shocks. Retail traders who entered the silver market during the rally may have been wiped out by the rapid collapse, particularly if they were using leveraged products or options contracts. These events also create psychological damage within markets. Confidence is a crucial element of financial systems, and when traders begin to question the stability of price discovery mechanisms, liquidity can disappear quickly. Banks, trading firms, and commodity brokers all become more cautious when volatility spikes, which can further reduce market stability. The human cost of these disruptions often goes unnoticed in the headlines, but it manifests in layoffs, business losses, and financial stress across industries connected to precious metals. When a key commodity like silver experiences extreme instability, the ripple effects spread through supply chains and financial markets in ways that extend far beyond the trading floor. The silver market is not operating in isolation. One of the major forces compounding the current situation is the broader global monetary environment, particularly the policies of central banks. Over the past several years, the world economy has experienced an unprecedented cycle of monetary expansion, followed by aggressive tightening. Central banks, led by the U.S. Federal Reserve, injected massive liquidity into the financial system during the pandemic period. That liquidity fueled asset price inflation across equities, real estate, and commodities. But as inflation began rising rapidly, policymakers reversed course and began raising interest rates at one of the fastest paces in modern history. This sudden shift created instability across financial markets. Precious metals, including silver, became caught in the crosscurrents of these policy changes. On one hand, high inflation historically supports demand for metals as a hedge against currency devaluation. On the other hand, Rising interest rates strengthen the dollar and increase the opportunity cost of holding non-yielding assets like silver. The result is a highly volatile environment, where macroeconomic signals push the market in conflicting directions. Investors are trying to balance fears of inflation against expectations of economic slowdown. When those competing forces collide inside a highly leveraged futures market, volatility can increase dramatically. This macroeconomic tension is one of the key reasons the silver market has become so unstable in recent months, and it remains a major risk factor going forward. Another factor intensifying the silver market's instability is the growing pressure on global supply chains for critical metals. Silver is not only a precious metal, it is also an essential component in technologies that are expanding rapidly, particularly renewable energy systems and advanced electronics. Solar panel production alone consumes massive amounts of silver, and as countries accelerate their transition toward renewable energy, demand for silver in industrial applications continues rising. At the same time, the supply side of the equation is facing challenges. Silver mining production has struggled to grow significantly in recent years due to declining ore grades, rising operational costs, and environmental restrictions in several major mining regions. Many silver mines are also byproducts of other mining operations, meaning their production levels are influenced by the economics of other metals like copper or zinc. This creates a supply structure that is less responsive to sudden changes in demand. When industrial demand rises while supply growth remains constrained, the underlying fundamentals of the market begin tightening. If this tightening occurs while the paper trading system is already experiencing instability, the combination can amplify volatility dramatically. The silver market therefore sits at the intersection of financial leverage and real-world supply constraints, a combination that can create powerful and unpredictable price movements. The implications of instability in the silver market extend far beyond commodity investors. Silver plays a critical role in strategic industries that governments increasingly view as essential to national economic security. Electronics manufacturing, renewable energy infrastructure, and advanced defense technologies all rely on components that require silver. If disruptions in the market begin affecting availability or price stability, the consequences could reach national policy levels. Governments around the world are already competing for control over key supply chains involving semiconductors, rare earth minerals, and battery metals. Silver is quietly part of that strategic competition. A prolonged period of instability could force policymakers to consider new measures related to mining investment, strategic reserves, or supply chain protection. At the same time, financial instability in commodity markets can also influence broader investor confidence. If investors begin losing trust in the mechanisms that determine the price of essential resources, capital flows across markets can shift quickly. In extreme cases, disruptions in commodity markets have historically contributed to inflation shocks, industrial slowdowns, and financial crises. While the silver market alone is unlikely to trigger a global economic crisis, it can serve as an early warning signal for deeper structural stress in the financial system. The dramatic move from the equivalent of $121 to $83 may ultimately prove to be more than just another volatile episode in commodity trading. Markets often reveal structural weaknesses during moments of extreme stress, and the silver market may be sending exactly that kind of signal. The global pricing of silver currently depends heavily on a complex network of futures contracts and derivative instruments that allow massive quantities of metal to be traded without ever changing hands physically. This system has functioned for decades because confidence in its stability remained intact. But when large price dislocations occur while physical markets behave differently from paper markets, questions begin to emerge. If the divergence between paper trading and real-world supply continues growing, the market could eventually face a structural adjustment. That adjustment might involve tighter regulations, shifts in investor behavior toward physical ownership, or changes in how exchanges manage leverage and settlement. None of these outcomes are certain, but the recent volatility suggests the current system may be under increasing pressure. For investors and observers, the most important lesson is to watch the signals carefully. Commodity markets rarely move violently without reason. When they do, they often reveal deeper economic forces that are still unfolding beneath the surface of the global financial system.